Hello, myself Dr. S.B. Yadav. Today I will take one problem on buyback of equity shares. That problem which contain offer price. All of you know that in buyback of equity shares problem there are two types of problem. If the offer price is given and if the offer price is not given. Now today that problem we are going to solve is nothing but the offer price is given. Let us read that first problem. The following is the balance sheet of RINA Limited as on 31st March 2019. Liabilities and assets. Equity shares of rupees 10 each. 42 lakh. That means 4,20,000 equity shares of rupees 10 each. Then 10% redeemable preference shares of rupees 10 each. That is 10,50,000. Profit and loss account 12,60,000. General reserve 14 lakh. Security premium 8,40,000. 11% debenture 70 lakh. Bank loan 56 lakh. Sundry creditors 31,50,000. Now asset side, that is 1 crore 40 lakh is there, fixed asset. Investment, that is 42 lakh. Debtors 19,25,000. Bank balance 8,75,000 and stock 35 lakh. Like that 2 crore 45 lakh is the total on both the side. Now what they said that keeping in mind all the legal requirement, ascertain the maximum number of shares that RINA Limited can buy back at the rate of rupees 40 per shares. You have to write necessary journal entry to record the above transactions. Now what is the important part over here is nothing but rupees 50, that is nothing but the offer price. The offer price is given. And we have to solve this problem by first method when the offer price is given. So let us start the first problem and the first step, that's step number 1. Step number 1, A part that we have to calculate. Now how to calculate A part? A part is nothing but the total of equity share capital plus preference share capital plus all free reserves plus security premium. That means here we have to calculate. I will calculate over here. See how much this plus this plus this plus 14 lakh plus 8,40,000. This is the amount of A. B. B is nothing but the borrowed fund. Now what is that borrowed fund? Borrowed fund 11% debenture plus bank loan, that is nothing but the borrowed fund. Borrowed fund is nothing but, let us calculate again. Here this plus this. Yeah, it comes to 1 crore 26 lakh. Okay, now C part is nothing but the number of equity shares. So number of equity shares, you know that 4,20,000 equity shares. So here 4,20,000 multiply by 25%, so it comes to 1,05,000. And D is nothing but the total of free reserves. What is the total of free reserves? Free reserves are nothing but profit and loss plus general reserve plus security premium, it comes to 35 lakh. So we got that three amount, that is 87 lakh 50,000, 1 crore 26 lakh, then 1 lakh 5,000 Sika value, and D's is nothing but 35 lakh. Now let us calculate the second step, step number 2. The step number 2 is very simple, that whatever the amount in A multiply by 0.25. So here I will calculate like this, multiply by 0.25, that is 25% of A. It comes to 21,87,500. Now second, this is very important. Here we make some mistakes. Okay, so here what you have to do, that separately you have to take A ka amount minus, here I will open the bracket, and B by 2. So B divided by 2 and close the bracket. So this is nothing but, so it comes to 24,50,000. D is very simple, whatever the D ka value is there, that just put D ka value over here. And fourth is nothing but the C multiplied by offer price. So here C is 1,05,000 multiplied by offer price is 50 rupees. So it comes to 52,50,000. Now how to calculate that AMTBB? AMTBB means amount of buyback. So amount of buyback is equal to minimum of 1, 2, 3 and 4. Now which one is the minimum amount? The minimum amount, I found that it is 21,87,500. So this is the minimum amount. I will mark as a red. This is what minimum amount. So minimum amount is nothing but 21,87,500. Now how much quantity, buyback quantity, BBQT means buyback quantity. So buyback quantity is nothing but that AMTBB, that means this divide by offer price. Offer price is what? 50 rupees. So amount of buyback or quantity of buyback is 43,750. What does it mean? For company can buy back maximum equity shares of 43,750. And what is the amount of buyback? Amount of buyback is nothing but this. Amount of buyback 21,87,500. Now once you get this particular amount, these amounts are very important. These figures are very important. Why? Because your whole answer is depends on this amount. After calculating that second step, now we will move to the third step. Now in third step, first of all you have to divide that offer price into two parts. What is the two part? The offer price is divided into two parts. First is your capital plus premium. So your offer price is what? 50. Okay, so 50 will be divided into capital. How much is the capital per share? 10 rupees. 10 rupees is the capital, and remaining 40 rupees is nothing but your premium. 40 rupees is a premium. So once you calculate this, then you have to fill up this two formulas. The first formula is nothing but the capital. How to fill up this capital? This we have to fill up by that quantity of buyback. How many shares that we are going to buy back? 43,750. Multiply by what is your capital per share? 10 rupees. So multiply by 10. So here you will get 4,37,500 is nothing but the capital. Now in this problem there is no proceeds of fresh issue. So here we will put that proceeds of fresh issue is what? 0. Now this we want 4,37,500 from where? What are the profits available for that 43,000 4,37,500? So we can take that from either general reserve or profit and loss. So we can use first general reserve. How much amount is there in the general reserve? General reserve 14 lakh and we want how much? Only 4,37,000. So we can take that 4,37,500 from general reserve. So which account we have used over here? General reserve. General reserve. Free reserve that we have used, and that is enough. Why enough? Because this 4,37,500 is equal to 4,37,500. That is okay. Now we want premium. We want to give a premium. How much premium that we are going to give? 40 rupees per share. How many shares that we are going to buy? 43,750. Multiply by 40 rupees. So premium that we are going to pay is more than capital, because 40 rupees is a premium and 10 rupees is a capital. So here 17,50,000 that we are going to pay. So first preference will be given to security premium. So what is that security premium? Security premium account, how much money is left out in the security premium? 8,40,000. So we can utilize that 8,40,000. Over here 8,40,000. Now we will find out how much balance left out. That means 17,50,000 minus 8,40,000. Still we required 9,10,000. So is that amount is available in general reserve? General reserve, how much amount is there? 14 lakh. Out of that 14 lakh, we use 4,37,500. So how much amount left out? Amount left out is 9,62,500. That is more than enough to cover up this 9,10,000. So we can utilize this 9,10,000 over here. From which account? From general reserve. Now look at this. We have not yet touched profit and loss. Profit and loss we have kept as it is. That is 12,60,000. We have not touched anything, or we have not taken any amount from profit and loss. So once you complete this particular formula, then you can go for journal entries, because this formula is very, very important. If you make a slight mistake, say for example, what is the common mistake the people used to do that in calculation of step number 2? Here you don't have to calculate a minus b divided by 2. You have to calculate b divided by 2, and then that amount you have to deduct it from the amount of a. So get that the correct value. Okay. So this is what the common mistake that we used to do. Okay, now let us see that what are the journal entries that we are going to write. So all of you know that there are 4 standard journal entries. Just like that redemption of preference shares, in buyback of equity share also there are 4 standard journal entries. You can write that journal entry first and then you can start. So first is that equity share capital. Now this amount you will get it from where? You will get it from first formula, this figure 4,37,500. So 4,37,500. Second amount you will get it from premium on buyback, that is from here. and 2 equity shareholders. So this is a due, 2 for buyback. So 2 equity shareholder. So here you can take the total of this. That is nothing but 21,87,500. That is exactly the amount of buyback that we are going to pay to the equity shareholder. Okay. Now second, next is the premium on buyback. So here that premium on buyback, you have taken it from which accounts? First is security premium and general reserve. So here I want security premium and general reserve. Profit and loss account is not there. So I will delete this profit and loss account because we have used only security premium account. How much amount we have used from the security premium account? 8,40,000. General reserve, how much amount that we have used? 9,10,000. And here premium on buyback is nothing but whatever the premium that we are going to pay, that is 17,50,000. Or you can take the total of this two. Which total? Total of this one. Same amount you will get, 17,50,000. Now next, amount to be transferred to CRR. Now which amount that we used to transfer and from where? First, GR, General Reserve account, we transfer to CRR. So here I have written that profit and loss, but it's not a profit and loss, but it is a general reserve. So I will write here, you can take profit and loss account also, no problem, but here I have taken a general reserve. General reserve account debit. How much amount that we utilize from general reserve? 4,37,500 to same amount, capital redemption reserve, CRR amount that we are going to transfer. And the last journal entry, that pay amount that we are going to pay is nothing but equity shareholder account debit to bank. Okay, so here how much that we are going to pay? Whatever the total amount, 21,87,500. Or here see this one, that amount we are going to pay. Finish. So this is the way, very simple way that you have to write a journal entry. These 4 standard journal entries are there, and all that 4 journal entries are based on your formula, this 2 formula. And this 2 formula we required this step number 1 and step number 2. When the offer price is given, here step number 2 contain 4 steps. Here ABCD you have to calculate everywhere, and this amount you have to calculate every time. But remember this, especially that you have to remember this step. Don't make any mistake over here, because through this mistake your problem or your solution will be wrong. So all these steps I have found out by complying whatever the restrictions or conditions are given Companies Act for buyback of equity. I hope all of you have followed this, and with this, thank you very much.